let's talk about the pandemic in terms of your story, which is you are basically the founder, right? Or is it one of the founders or the formal founder of WallStreetBets?
The one and only founder of WallStreetBets.
I love that. So, how do you feel about that? Are you proud of that? Are you have any mixed emotions about that? Do you think it's all good, all bad, or somewhere in the middle?
Yeah, I think if I started WallStreetBets and then a day later I woke up to what it is today, I would be completely baffled, right? Like it is grown beyond my imagination. But because it was a really slow, progressive growth and stuff, first the forum starts getting pretty big and it starts getting millions of users, and then it starts doing some stunts that end up getting the attention of the media, and so I start getting less and less surprised as time goes on. But I'd be lying to say if I predicted or I imagined at any point that this community would turn into what's feeling in some places like a movement, like an ethos for a whole new demographic of participants in the stock market.
What year was it when you actually founded WallStreetBets?
I started it in 2012.
Okay, so that's about 9 years ago, right?
Yeah.
And what gave you the idea for it? Was it just one day you decided I'm going to start off and create a subreddit, or it was an inspirational moment, or just hey, let me just try something as like sort of like a lark, and next thing you know, it becomes real.
Yeah, I mean, pretty much like back then I was in my early 30s. I'm single. I had a great job and it was leaving me, a fair amount of disposable income. And although I had like all the typical retirement pension funds, whatever, like the 401ks or whatnot.
What were you doing, by the way? Just curiosity.
At the time when I started, I was working at the Inter-American Development Bank, and I was working in the risk area, working between, it's kind of like a liaison between the tech side of things and the treasury liquidity type stuff. So, obviously a lot of the banks that use technology to do their business, and they're constantly in the need for better solutions for mitigating risks.
So it's not like you have a background in this stuff. So it's not like one day you're like a guy walking down the road and you're having a slice of pizza. You're like, I'm going to form a Wall Street bet. You're a financial guy that was in tech. So it's sort of you were bridging both worlds in your actual employment at the time, right?
Yeah, I mean, you could say that, right? Because that's my aspirations. At the time, I'm still kind of in my early stages of learning and getting experience with these things. And my thought was, oh, okay, well, the stock market and finance, they have stuff to do with each other. And they do, really. They obviously are very related. But when I started kind of playing around and wanting to use my extra money to make some more aggressive plays, that's when I realized, it can also be extremely disconnected or separate from finance. Like if you reduce the type of activities that we were interested in, it was looking at little pictures on the screen with things move up and down, and that's it, right? Like if I were to really, really break it down, and that really doesn't have stuff to do with finance. I also complement that with the knowledge of it, so that I can understand what the different players are doing, right? If you're thinking about playing poker with different players, that guy bluffs a lot and that guy's real conservative, whatever. It's kind of the same thing. It's like, all right, well, this book value and the market value, there's a disparity thing, and the news is talking about whatever, and the interest rate, these macro level things, right? So now I know that there's a lot of players in that space, and so I can expect things that happen there. But there's also, computers that just do stuff that based off of speed and statistics and scalping little tiny fractions of a cent and different types of participants. So I learned about it, right? But after learning about it and knowing about that, I still realized, okay, well, I guess I have more knowledge and I could talk more about it. But when it came to actually making trades, it really didn't map out to any of the former knowledge I had.
So what you're referring to, I think, like when I grew up in Wall Street, was the idea that there's essentially two types of analysis. There's fundamental analysis and there's technical analysis. And technical analysis is more about the short-term trading patterns. And back then they would these charts and say head and shoulders top, head and shoulders bottom, and all these different things. But it was really more about the trend, so to speak. It could be volume, could be highs and lows. It could be that the odd lot theory, like when small investors were buying, then it was the time for you to start selling. All those different things. They were not based on the actual Warren Buffett-esque fundamentals of analyzing the balance sheet, the value proposition, and more of a long-term play. So that was sort of like what you realized, that fundamental analysis, Warren Buffett-type investing, doesn't really hold up in these sort of short-term plays you were looking to make in the market. Is that basically the story?
That's exactly right. And I wanted to do the short-term stuff, right? Like I'm not interested if I'm throwing a couple $1,000s into the market in a given week, I'm not going to turn that into my $1 billion that I really want. If I'm able to turn that $1,000 into $5,000 or $10,000 in a week, then I can start playing in my head and fantasizing about what's possible.
And here we go. By the way, I got to stop you because here we go. And this is the issue, because you're hitting on something so profound here. I'm not sure if you realize it, but because obviously, if you were to look at this thing from the 10,000 mile view down, you're like, well, you have this Warren Buffett sort of proven long-term fundamental value, long-term value proposition, buy ETFs and hold them. Even Warren Buffett will say, you're better off buying the market, the S&P, and holding it. You'll beat out the hedge funds. The problem is, while that strategy might work for Warren Buffett, who has billions of dollars at his disposal, it doesn't make a lot of sense. Let's say it doesn't really move the ball for an average small investor, because you have a couple $1,000s. Okay, so you make 14% a year, big deal. How does that move your needle in your everyday life with your family, paying your rent, buying the home of your dreams? So the disconnect, I think, occurs right there, that while it might make a lot of sense to do the Warren Buffett play, what do you get from that? That's your side of the story. Am I right?
Yeah, and the beauty of it is they're not mutually exclusive. Remember, I had my Warren Buffett retirement account, and that was what I was going to use when I stopped working.
Excellent point.
And I'm contributing, and my job is here, and someone else is handling that stuff. But I want to speed that up. I want to get rich faster. I want to be able to have more, whatever anybody is looking for when they want money, or maybe learn, right? Like, I realized it was risk. I know risk and return are married and they're uncouplable. And so I'm like, all right, cool. If I lose a few $1,000, that's probably bring up the fact that I was single, right? I didn't have a wife or kids to feed. And so it was risk that I was happy to take. And nobody likes to lose money, but I was cool with it because I also knew that I was buying an opportunity to make money.
Absolutely.
And so, yeah, you hit it right on the head. As time went by, this whole thing evolved. Now there's a whole new beast and participant in this market, which is what's, to me, really fascinating. Where we had the fundamental and analysts, and they have the technical analysts. Now there is a new genre that I couldn't have predicted, which is, I don't think they have a formal name, but meme traders is the closest I can get to.
Yeah. I think we would call it here, because it's a really good point and probably should be coined. Maybe we can coin a phrase. But what it really is, it's the collective buying power of the average small investor. In other words, it's like they used to be, and I get this, by the way, and I can't tell you how intimately I know this area of the market. It's like when I lived in my 20s and 30s, this whole psychology of what drives people to take action, why they buy, why they sell, why people bail out on the way up, this FOMO. We had different words for it. We called it the greater fool theory. That was our biggest one. Like, what's a stock worth? Well, it's worth whatever a greater fool than you is willing to pay for it. If they'll pay, $10.10, then it's worth $10, right? Theoretically, right? So I think the point you're saying is there's this new genre, really, which represents the collective buying power of people connected on a social platform here that share a common investing philosophy and are willing, without it being collusion, to generally stick together with their sort of paradigms and their ideas. Because without that, it doesn't work. Am I right?
Yeah, but it's only a part of the story. What you've just described was what we saw in GameStop, right? That's what we saw there. This collective buying power, moving prices around, and that's a fascinating topic. Much more complicated, much more intricate, and much more nuanced than just a lot of people buying on this side and people shorting. But the overall theme that I see with this group of people is, in this case, they did a short squeeze. Let's just go ahead and call it that. But previous to that, it's this millions of individuals that they're hungry for risk, and they're very savvy. They're tech savvy. They're distrustful of the stock market. It's also probably why the whole cryptocurrency thing started in the first place. And they're looking for weaknesses in the system to exploit them. So, I'll tell you about, you may have heard of a situation that happened in 2019-ish, or maybe 2018, where some guys figured out that on Robinhood, if they sold a covered call, that money you got from that call was not collateralized properly, meaning they allowed you to do whatever you wanted with it.
It should be locked up, right? They're able to use it again, essentially, right?
Should be. And they bought deep in the money calls. Sorry, they sold deep in the money calls. So they basically got their money back times two, right? And so they would do that again and again and again, and they would keep doubling the size of their buying power until they take a $5,000 deposit, turn it into $1,000,000, right? And then just YOLO it on some earnings call, which is pretty crazy and reckless and fascinating and whatever, right? But that was an exploit that they found, and it obviously ended poorly for lots of people and made money for some people. And the net result is there was a temporary inefficiency, there was a gap, and now it's closed. Now you can't do that obviously anymore, but so they're on the constant hunt for these things. And sometimes it's let's push the price up. Sometimes it's let's get a ton of leverage. Sometimes it's other ARB opportunities, which are really creative.